This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant currency on the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we are going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at U.S. home building as low affordability carries over into 2024.
Plus, weakening consumer sentiment in the video game industry. Can global gaming turn things around?
But first, you got record spending and cost controls could fuel broader-based earnings per share growth for North American utilities next year. So I want to dive into that with Bloomberg Intelligence utilities analyst Nikki Xu. All right, Nikki, are we going to have a catalyst for utilities next year?
Yeah, so I guess I'll start out with the factors driving this year's performance. Most of these factors are likely to carry over through next year, but there are some clear tailwinds. So for utilities, they are considered defensive and viewed as strong proxies because their earnings are predetermined by state regulators. And the predictable earnings allow them to pay out 60 to 70% of their annual EPS. So it's no surprise that it's been tough for the sector this year, given the high bond yields and the expectations of a soft landing, which make utilities dividends and defensive quality less appealing. So, but for starters, for next year, we do see cheap valuations, right? The S&P 500 Utilities Index historically traded at almost parity to the broader market, but it's trading at about a 4-10 discount right now. And bond yields are coming down, right? Despite the different views on the timing and the pace of the rate cuts. And fundamentally, we are seeing solid, broad-based EPS growth and cash flow improvements. Consensus is calling for mid-single to high double-digit EPS growth for the 26 S&P 500 utilities, mainly because of the Inflation Reduction Act. The tax credit lower costs for renewables and drive utilities record capex, which in turn drive their earnings.
All right, so on these North American utilities here, talk to us about rate regulation. Where are we? Are some companies more exposed or have more headwinds there?
Right now, with the high electricity prices, customer bills are increasing across the nation. But we're seeing lower return on equity authorized by regulators. And for some states, sometimes we actually get some surprise, and it's not a good surprise. For example, the most recently we see in Illinois, the ROE approved by the regulators are lower than expected. And then on top of it, the regulators pretty much just reject utilities' great plans and telling them that, okay, whatever you propose here, you need to go back to redo them. So it's a pretty surprising outcome. The stock actually for Exxon and Emeren, both of them stock fell about 7%. And you could see consensus also have came down a little bit lower by about 2% so far. So it's always difficult to predict which states will probably see worse outcome than the other. So that's why we are highlighting some companies that have some pending regulatory decision. Obviously, we talked about Emeren and Exxon already. There are also, I think, Pinnacle West and Excel also have some pending regulatory decisions coming up.
When we get these utilities that have to manage the transition to solar and to wind, but maybe they still have some coal, maybe they have a lot of natural gas, maybe they have some nuclear. Is the IRA helping or hurting? It feels like these guys are very much stuck in the middle, and if you're regulated, very little way to sort of make money.
So for utilities, the way how they make money is by spending more capital, right? The more they invest, the more the faster they can grow their rate base, and rate base drive their earnings, right? So the Inflation Reduction Act definitely is a game changer for the industry. It's driving their record capital spending because it lowers the renewable cost. So now they are able to replace their coal-fired power plants with renewables at a probably faster than before. The problem right now is the high cost to the customers because we have, like last year, natural gas prices are so high, and gas prices drive power prices, right? And we also have 8% inflation. So customers are still struggling with the bill payment that utilities are deferring this collection from last year. They're still collecting it now. So regulators started to worry about the impact on customer bills. So the concern here right now would be if utilities trying to move faster and build more renewables, there's gonna be a big hit, a big pressure on customer bills. And that's why you're seeing Illinois regulators saying that, okay, I'm gonna give you a lower ROE, and also you should probably go back to review your proposal for your plan for the next 5 years, just so that they can manage the customer bill impact.
Nikki, appreciate it. A lot to kind of get through there. Nikki Xu, Bloomberg Intelligence Utilities Analyst.
Let's turn now to agency mortgage-backed securities, which could see a boost from less restrictive Fed policy in 2024. For more, let's bring in Bloomberg Intelligence Senior MBS Strategist Erica Adelberg. So, Erica, let's start just with 2023. I see total return here of 3.77%. That seems pretty good. How about for next year?
Hi, Paul. Nice talking to you. We actually, some of the performance was probably pulled through already to 2023 compared to when we put out our outlook. But we are expecting treasuries to fall probably another 50 basis points at least down to the low threes, 322 or so, based on the fact that as the economy slows and the Fed, possibly goes to a easing stance, that'll help treasuries have room to fall. Mortgages should do very well in that environment, we think, because they have long duration, so a lot of exposure to treasuries, but also, a more lenient Fed policy probably allows volatility to fall as well, which is good for mortgage-backed securities in general. So we think we could see, probably another 8 basis points or so of return in that scenario.
So for mortgage-backed securities, a slowing economy is better?
What's been tough over the past year is just this rise in inflation and the tightening of Fed policy has really pushed rates up. And so as a result, because mortgages are very exposed to duration, they're very exposed to interest rates, that as interest rates have gone up, that means prices for bonds have fallen. And mortgages themselves are longer than usual in terms of their exposure to interest rates because as interest rates have risen, fewer and fewer homeowners are relocating or refinancing. So those mortgages are outstanding for longer. That gives them extra exposure to any moves in interest rates. So they've done pretty poorly as interest rates have risen. We feel that could reverse if the Fed goes to a tightening easing stance where they begin to lower interest rates.
I'm a little surprised that maybe the performance mortgage-backed securities, in the rally we've seen here in the fourth quarter here, hasn't been more. I've seen U.S. corporate high yield up 12.2%. I thought the mortgages would have done better than the 3 or 4% that they've had. How do you think about that?
I think about that in two ways. One, it seems to me, and talking to our corporate strategist, I think he'd agree, that corporates are really priced for an incredibly strong continued economy, not just with lowering inflation, but then easier Fed policy helping corporations increase their profitability. Mortgages don't have quite that economic tailwind. What we're hoping for is that volatility falls, and so far volatility hasn't really fallen as much because there is some uncertainty still as to the path and timing of the federal funds rate and interest rates in general.
Historically, in a Fed cutting cycle, what happens to mortgage-backed securities?
Historically, it depends on the timing. Like at first, when the Fed pauses, volatility often has the ability to fall as we're kind of in a stable environment. But then if the reason that the Fed starts to cut interest rates is because we're heading into a recession, sometimes that has the opposite effect where volatility can rise. We don't really know what's going to happen. Maybe banks are going to collapse. Depending on how hard a landing it is. That is not the scenario we're expecting. We're expecting maybe a mild slowdown at worst and probably, maybe even a Goldilocks soft landing scenario. But in the event of a hard landing, we actually do think corporate bonds probably get hurt even more because credit will tighten and that'll be tough for their profitability.
All right, Erica, when I bought my Jersey Shore compound in March of this year, high interest rate on my mortgage, 6%. But then, of course, it went a lot higher than that, so I don't feel so bad now. But as rates come down, man, I'm going to refinance that thing. What does that do to the mortgage-backed security?
That's a very good question. Some homeowners may already start to refinance. We're beginning to see the refi indices pick up a little bit. It looks like just a blip really now if you look at the charts, because from a longer-term perspective, there's still so few homeowners who did have to take out mortgages at the top level of the rates. And we'll see in the mortgage banker survey tomorrow whether or not a few more people are jumping on that bandwagon. But for those borrowers who, decided, I'm not going to pay points, or I can't pay points, usually it's if they decided not to pay points because they expect interest rates to fall, those homeowners are going to be prime targets for mortgage servicers to try to refinance those loans, and it's going to certainly give them a lot of incentive to do, both the homeowners and the lenders, to try to get that process going.
All right, Erica, thanks a lot. Erica Adelberg joining us, a Bloomberg Intelligence senior MBS strategist.
Coming up on the program, will U.S. Airlines reach new heights in 2024? We'll take a look.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through VI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
U.S. airfares are starting to sag, especially for domestic travel, and may hurt airline profits as higher expenses temper results. For more on this, we're joined by Bloomberg Intelligence senior aerospace, defense, and airlines analyst George Ferguson. George, my personal travel policy is I only fly when somebody pays me to, but these planes are pretty full, though. Give us just a sense of the revenue outlook for the airlines these days.
Yeah, so I think one of the challenges lately for analyzing the industry is we all get in airplanes and we say, wow, the planes are full, so the airlines must be making a lot of money, right? The problem is what matters is what everyone pays to get on the airplane. And so, what we were seeing in 3Q was that the low-cost carriers and the budget carriers, we were seeing fares starting to slip. We measure it with yields, price paid per mile flown. So it feels to us like the consumer, especially the consumer, without as much disposable income, is starting to have, a little bit of a problem affording travel.
Or do they just not want to go to Florida? They want to go to Venice. And by Venice, in Italy.
Yeah, I think we saw some of that this summer, for sure. Mm-hmm. That was the higher end traveler. Definitely, it was going to Europe was in vogue, but that's not the common traveler, right? Those are the uncommon travelers. Those are the well-heeled, right? And so, that was a absolute bright spot this summer, was the demand into Europe. It felt to us like a bounce back, again, from those pandemic years where you couldn't go to Europe. Whether that happens next summer, don't know. I kind of think that bounce back might be over. But more concerning is the broad rank and file that are flying domestically, going to Disney, going to Vegas, and that travel, the domestic travel, appears to be down as of 3Q. And we think as we go into next year, that's a continuing trend. Even I think we're seeing it in traffic in the parks. Right? You're in Disney traffic might be down a bit. I'm seeing some of it in retail. When I talk to retailers that look at results aren't down 20%, but they're down a bit. That incremental traveler, I think, isn't flying as much, and we're starting to see airlines cut fares so they could fill airplanes.
Well, just, on that end, I am going to Ireland next September. So I will be going back and doing my fair share for international spending.
A couple years late, but good job.
Yeah, exactly.
Good job.
Exactly. I want to let the riffraff go first. George, where are we on capacity here? Because I know during the pandemic they took a lot of capacity out. Where are we in kind of right sizing again? Where are the airlines?
Yeah, so we're back up over 2019 levels of capacity. I think November was a record for the amount of flying that was done. And so I think that's part of the issue here, right, is that the airlines had all those airplanes during the pandemic. They parked them. You start flying it again. You restore all your routes. Leisure stepped up and really, I think, helped the airlines during the summer. Business hasn't stepped up to the level that it was pre-pandemic, right? We think still sort of 80%-ish. We're going to see as we get into 4Q and 1Q. Typically business would help carry some of the burden in those quarters. We don't think they'll be there. That'll be another reason I think airlines will have to discount a bit to fill the airplanes in those shoulder quarters. And then we're back into summer 2024, and summer 2024 doesn't feel as strong to us as summer 2023, but I mean, we have a little bit of time.
Can we read into the domestic flights as a foreshadowing of what the bigger guys like Delta and American Airlines and United are going to do, or can we not make that comparison?
No, I think you can. Again, I think what we've really seen since the pandemic was when a market reopened, there was a push to get into, to fly to that region as sort of a catch up. And most markets have had that opportunity to catch up. There's only one market left that hasn't had that catch-up period. I think it's Asia. Asia could potentially be a bright spot in 2024 because there's pent-up demand. That's really a Delta and United opportunity because they do the most flying in the region. American's a bit small. It's not something you fly with a narrow-body airplane. So as we think of bright spots, that can be out there. But like I said, domestic was sort of the first to reopen, and people piled in, and we saw a great bounce from that. And so if that sequence continues to follow, Europe's bounce would have been this summer. Asia-Pac could be next summer.
How tough is it to run a low-cost airline? Because I can't even imagine this business model charging a couple $1,000s a seat to some muckety-muck. But how do you do it at $300-$400 a seat?
I think it gets increasingly challenging, right? So one of the great things about being American, United, and Delta is that you have these classes of service. You get those consumers that are, like I said in the beginning of the discussion, well-heeled. And so they're willing to pay up for some of those creature comforts that helps you build margin. That's been one of the strong parts of the business. When you get down to ultra low cost and low cost carriers, it's all about the seat price, right? It's all about the seat price. And the challenge there too is that the price of the travel, like Frontier and Spirit, where you pay for the baggage, you pay for the seat, you pay for the overhead, you pay for a little extra leg room. Others haven't, like Southwest. And so the challenge too is getting into the consumer and helping them understand exactly what they're buying. So you're in a very competitive market where some folks are trying to bundle things still but show the value. Others have totally unbundled it to get that consumer to hit the cheapest price. And on top of all this, while you're busy managing that kind of competition, if you're Frontier and Spirit, you're trying to keep the employees there, right? Because I'll tell you, the pilots get paid more at Southwest and Delta and American United. So you got to find a way to recruit pilots, keep them at your airline, recruit the line workers and everybody else. It's a juggling act, and right now profits aren't there in that business, so it's a little harder to give away more money to workers to keep them there. I think it's a challenging business to run.
To that point, what's different now about this environment than it was 5-10 years ago? Like, we make the same argument in 2014.
So I would say that wages are higher, and that's a challenge, right? As you go through these inflationary times, again, you don't want to give away so much to the employees that you have a hard time making a profit. You are a budget or a low-cost carrier, so you're trying to provide seats as cheap as possible. I do think that the introduction of the ultra low-cost carrier to the U.S. market is a big change too, right? Spirit and Frontier emerged, and they took sort of the Ryanair model where you uncouple everything and you buy exactly what you need for your flight, right? If you don't need a check bag or an overhead bag, you don't have to pay for it. But if you do, you're gonna have to pay for it. And I think the U.S. consumer didn't understand that model as well. And like I said, so it got hard to sort of differentiate your product if you were a Southwest. And U.S. consumers, we just don't get as much vacation as our European friends, right?
Yeah, we know.
And that means that they're out on airplanes more frequently. They understand when they're flying Ryanair into Barcelona that they're not getting a lot of frills on that flight. They understand what they're buying when they buy that ticket. They're saving it all, I guess, for the restaurants in Barcelona. When you're Southwestern, you're competing against Frontier and Spirit, that customer may not understand that as well. So it just makes it harder, I think, to show,
Yep.
Again, what you're offering. And I think that's made this business a lot more challenging. And I think there's just more capacity.
All right, great stuff. As always, George Ferguson, Bloomberg Intelligence, Senior Aerospace, Defense, and Airlines Analyst.
Coming up on the program, with U.S. homebuilders overcoming stagnation from low affordability in 2024, will that be the case for next year?
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So the U.S. housing market will continue to grapple with historically low affordability in 2024, but, according to BI, home builders like D.R. Horton, Lennar, and Pulte are well positioned to take some share. Drew Reading joins us now, Bloomberg Intelligence Senior Home Builders Analyst. All right, Drew, why aren't things going to look a lot better next year if rates are coming down?
Well, rates are coming down a little bit. Right now we're at about 6.8, which is down from 8% in October. But what you have to remember is that 70% of homeowners, current homeowners with a mortgage, still have a rate below 4.5%. So even though rates come down, there's still a gap there to make the math fully work. So we do think that with rates coming down, it's going to unlock some demand in the existing home market. So we think you could see sales up in the low single-digit range off a low base. But, against that backdrop, we do think that the builders are in a particularly good position. And we're kind of describing them as being at the top of the U.S. housing food chain. And we do think that the new home market's going to continue to take share from resales. One is because of the lack of inventory in the resale market. The other thing you have to realize is that if you look at the number of homes currently for sale in the U.S., about 30% are new homes, and that compares to about 10% historically. Wow, so one, it's an inventory thing. Two, it's the fact that builders have been able to buy down rates and make the math look a little bit better for buyers.
Drew, I'm looking at these home building stocks, and one's better than the other. They're up like 70, 80, 90% year to date. These things have ripped. There can't be anything left for 2024.
Yeah, it's been a wild ride this year, and you're right. Depending on the name, they're up between 70 and 150%. Just since the end of October, when we first started to get the idea that maybe the Fed is done with the hiking cycle, they're up 40%. So
wow.
Valuations are certainly more balanced, I would say. The group as a whole on a market cap weighted basis is trading at about 1.6 times, which is roughly in line with the long-term average. If you look at some of the smaller builders, that's where you see more of a disconnect between their valuation multiple and what would be implied by return on equity. But certainly that run-up has kind of put the onus on the builders in the spring selling season to show that this pullback in rates and this rate trade is more than just a trade, that it's actually going to turn into something tangible in terms of fundamental results.
When rates are high, do home builders have to make concessions to sort of clear their houses, even though demand is really high? And if that's the case, what are we noticing now as rates come down?
Yeah, it's a great question. It's been probably the biggest story over the last 6 to 9 months. The biggest concession that you see across the space is the interest rate buy down. And even with strong demand, if the affordability is not there and people can't afford the payment or don't want to because they were shopping, 6 months ago at 4% rate, then they need to do something to drive traffic. And it's been through rate buy downs.
What's a rate buy down?
So basically the home builder will either buy down your rate to their mortgage company. So somebody shopping out in the market who's looking at a headline rate of, call it 7%, will go to the builder. The builder would pay points up front, and they would buy down your rate to 5.5%. There is a cap on that. I think it's about 300 basis points. But the other thing they do is forward purchase commitments, where they go to a lender and they buy pools of loans at a specified rate before they even have a house sold. And then they apply those mortgages to the buyer. So it's been rate buy downs. But the good question is, does that continue? And as rates have come down to about 6 3/4 now, the cost of driving traffic next year becomes lower. So if a builder wanted to get the buyer to a 5.5% rate, because that's kind of been that number where they've seen a tangible impact on demand, before they had to buy it down from 7.5% to 5%. Now they have to buy it down from 6.5% to 5%. So that the incremental cost becomes less next year.
Are short sellers coming into this group? I see a move like this, and I think, boy, they got to be licking their chops here.
Interestingly enough, it seems like because the builder business model has strengthened so much compared to what it has been historically, you're actually starting to see the opposite. There's more discussion around a potential re-rating in the names over the longer term. And that's really based around a couple factors. The first is that these guys are operating with historically low leverage. I mean, you can remember the situation they got themselves into last time where they're over-levered and a lot of names went bankrupt. Historically low leverage, they're generating a ton of cash, and they're applying that to share buybacks, which we think is something that's going to continue into this year. And then the last thing, and perhaps the most important, is that they've taken a more asset-light approach to the business model. So instead of owning a ton of land outright and keeping it on their balance sheets, they option it. They pay a percent of the total cost of the land up front, and they take the lots down as needed. So it's a more capital-light business model, and there's less risk involved as well.
So many questions. One of them is, which kind of builders are doing the best? Is it lower tier housing? Is it luxury? Is it those that are geared towards the first-time home buyer? Which ones are going to see that outperformance?
So in general, the strength has been pretty broad-based, and they're all benefiting from the fact that the new home market as a whole is taking share from the resales. That being said, in an affordability-starved market, we tend to prefer builders with a focus on affordability. And the good thing is a lot of them are doing that now, whether it's through just overall lower base prices or lowering the square footage of their homes. Even a Toll Brothers has a product that they call affordable luxury, which they compare to the 3 Series BMW. So it still has that flashy Toll Brothers brand, but it is at a lower price point. So we think that that's where a lot of the demand is going to come from in the coming years. It's the lower end. But in addition to, just who you're selling to, one of the things we look for across the space is who has scale. So in a volatile cost environment, who could leverage the trade base, who could consolidate labor when there's not a whole lot of it, who could get lower prices on land deals. And the two names that fit that mold would be D.R. Horton and Lennar. They're really the only two that have any type of scale at the national level, both at about 10 to 12%, call it, compared to the next largest, which was only about 5%. We think that in this environment, it is important the product you're selling and getting that right, getting to the right price point, but it's also, how are you running the business?
I'm looking at a price chart for lumber over 5 years. Boy, that's volatile. But that's the bad news. The good news is it's not like a 5-year low now, so that's got to be good for the margins for these home builders.
Yeah, you make a good point. Lumber has probably been the best tailwind for the builders of late, and it's kind of helped to offset some of the damage that's been done with the incentives. I would say that, construction costs as a whole, whether you're talking about, lumber or you're talking about cabinets, flooring, anything that goes into the home, have been extremely volatile, and the pricing has been, dramatic, to say the least. But what we're seeing is that prices aren't coming down, but they've stabilized. So builders have better insight, into what they're going to be paying, and they can adjust pricing as necessary. On the lumber front, we would expect that with the pickup in housing starts, and we saw, a good print today, we would expect that you could see lumber start to rise again a little bit as we get into next year. So that'll be something to watch out for.
Drew, thanks a lot. Could talk about this all day. Drew Reading is a Homebuilders BI Senior Industry Analyst. Thanks so much. All right, let's pivot now to global gaming, where yet another year of weakening consumer sentiment could add pressure on some new releases. I always thought that gaming was like recession-proof. Anyway, Bloomberg Intelligence technology analyst Kevin Tsao joins us now. Kevin, what about that? I thought that gaming was recession-proof because it was so awesome.
So I think for the larger titles, the very well-known franchises, names like Call of Duty, it's recession-proof to an extent, right? I mean, consumers still feel pain. They'll stick to the larger titles. But for the smaller titles, for new releases, new franchises that are trying to launch, those are the franchises and titles that gamers, when under sort of a weaker consumer environment, are less likely to try out. They're still going to go towards the bigger names, and I don't really see trouble there, but new releases could have a harder time.
So what percentage of a gaming company's revenue is from recurring revenue from existing titles versus new titles?
It differs for each one. For example, EA has a very large amount that comes from their annual sports franchises. They see a significant amount of revenues from them. Call of Duty, obviously, for Activision Blizzard, has been a significant contributor to revenues. But quarter on quarter, individual releases still matter.
Why is it hard to sell gamers on new stuff?
It's like the movie
business. In a weaker consumer environment, when you have a franchise that's well known, you have a semblance of what the gameplay is going to be like, what the game is going to be like, what the quality has been like historically. Me and my friends have had fun playing this game, and there's a couple modes that we really enjoy. With new games and new franchises, that's all unknown. So once it becomes lesser known, then gamers are uncertain of how much enjoyment they could potentially get out of the game or what kind of gameplay they could even see.
So, Kevin, big deal in your industry this year is Microsoft buying Activision. What's the expectations about how they're going to manage that asset?
Microsoft has been relatively hands-off with much of their assets before, and we think it'll be the case going forward. Obviously, there's licensing deals preventing them from directly owning part of the cloud gaming portion that could come from Activision games. That's obviously gone to Ubisoft, and we'll probably see that license backed onto Xbox Game Pass. Other than that, I think it'll be business as usual for Activision Blizzard. You'll see most of their near-term titles on both consoles, PlayStation and Xbox. Further down the line, and I do mean much further, past 5, maybe even 10 years, you'll probably see more titles become Xbox exclusive as they've done with former acquisitions like Bethesda.
But like Paul brought up in terms of, say, consolidation, not only that we're seeing in the industry, but also streamers, right? Like Netflix, aren't they trying to get into gaming also? What do you think is going to happen there?
With Netflix pushing into a AAA title, which they have under development at this point, it's hard to say how much success that they'll have. I do think it's incremental in keeping people engaged with the platform, especially not just within TV shows, but, offering a variety of mobile games to play and keeping their consumers engaged across multiple different formats as well, not just, on TV or on the PC, but on mobile as well, and potentially even, offline as well if you're playing, an offline game that they offer, such as their new collaboration with Grand Theft Auto to bring their games on the platform.
I almost hate to ask this question, but I have to. How is generative AI impacting the gaming business?
That is a very hard question to answer, but how we see it is that near term, we believe that benefits will likely not really be visible. We think in the outer years, they'll be able to contribute to, a suite of tools that will help iterate on assets that could be used in gaming, iterate on potential NPCs, on NPC interactions, on sort of chats and the sort of interactions and more human-like interactions that you could potentially get from these NPCs. And one thing that we did see more recently is in the GTA 6 trailer, they seem to be employing some generative AI and filling out the world with playable characters and making it feel more alive. We think that will probably be something that will be visible in the next 2 to 3 years, and longer term, it could potentially replace bug testing or even procedurally generate levels. But that's much longer term, and we wouldn't expect to see that probably within the next decade.
Hey, Kevin, thanks a lot. Really appreciate it, Kevin Tsao. He's Bloomberg Intelligence technology analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.